Now, for more on how the Federal Reserve's easy money policies are playing out in Europe, we're joined now by Frank de Boer. He is the chief executive of Max.xs. That's a financial services company, and the company represents over 25,000 European asset managers. Frank, good to have you with us. So can you explain, when you say represents these investors, these 25,000 investors, what exactly does that mean?
Well, we represent basically a variety of investors. These are intermediaries, IFAs, institutional investors looking for allocating their assets to several asset classes. Amongst others also, of course, European and US asset classes, Asian emerging markets. That is what we do. We basically help asset managers to gain access to the European marketplace, predominantly the German-speaking countries.
And so are you able to watch the flow of funds? You're able to see where money is being allocated?
Yes, that is one of our, of course, major objectives, to see where the money is going, because we live from representing these asset managers, and as a sales organization, we are basically remunerated on the basis of the assets that we are able to place. So what we have seen in the last couple of years is a retraction in the German-speaking countries to more fixed income investments again, away from equity investments, away from hedge funds, because the correlation obviously was there, although it was promised not to be there.
Is there any change that you've noted recently? I mean, interest rates, both in the United States and in Europe, they're quite low.
Yeah, that is a real problem, especially for the German investors, as they have historically 85% of their assets in fixed income instruments and are confronted with this very low returns on their assets. They need to find a way to get out away from that, but haven't found a solution. If they are investing in equity, they probably hedge even that exposure with put options. So the real problem is how to allocate the money. We have seen allocations to high-yielding corporate debt and to emerging market debt as well, but the equity investments are still very limited.
What about investments in commodities? Have you seen any fund flows towards things such as gold, silver, oil, as well as all of the agricultural commodities?
Yeah, absolutely. If you look at the more retail, private banking environment, a lot of investments are going to commodities like gold, oil, etc. But also real estate, again, is very much in favor of investors, both on the institutional and on the retail side.
What is the perspective of European investors when they look at what's happening in the United States, and particularly the Federal Reserve's quantitative easing policy of pumping in about $600 billion into the U.S. market?
Well, a big issue, of course, for European investors is the currency risk that goes along with that. I mean, I think there's a lot of unease about the currency rate, US dollar to euros. This is a big concern to a lot of investors. The other big problem...
But just when you say concern, do they perceive it as being in some way out of whack, that it's not at its correct level based on what you can buy for a dollar versus what you can buy for €1?
Well, they see a huge, of course, risk in the dollar further sliding away against the euro by the happenings, the proceedings of the Fed. That on the one hand. On the other hand, what you see is that the growth in the US is not on the level that one had expected. The question is how it can be picked up. I think that even in the US, the politicians are not very much in line on the way that they want to take the risk on. There might be a gridlock on the political level. So you might say, okay, that is at least avoiding further spending policy in the future, but it poses a risk if you don't know where the growth has to come from, if you don't know what the programs that the government will implement will lead to, what kind of industry sectors they are going to perhaps help to further that growth. That is, I think, a main concern to many European investors at the moment, that they don't know if the US can sustain this level of economic growth and go beyond that even.
Now, with the strengthening of the euro versus the dollar, doesn't that make dollar-denominated assets look even more attractive to European investors? Do they not want to put their money to work here in the United States?
Well, I think there's as a big concern still the price that you get on the U.S. assets is not that high. If you take into account the currency risk that you are running, if you look at the fundamentals, this is certainly a risk that investors see and where they're still hesitant to invest in the U.S. market at this level.
All right, so if they're still hesitant to invest in the U.S. market, do they perceive that the Federal Reserve's policy is going to devalue the value of debts that are denominated in U.S. dollars?
There's a lot of, they see this risk that this could happen.
And that is something that this could hurt them, and that's why they're not going to be buying?
Absolutely. That is the risk that they see, that the dollar could slide away against the euros further, that there might even be a problem with rising interest rates on the long run because of this printing machine, which is also posing a risk, of course, to the fixed income investments that they would have made by then.
Is there any specific number that they would be looking at, 150 euro versus the US dollar?
No, I can't say that number, no.
All right. I want to thank you very much, Frank de Boer, coming to us from xs Financial Services.
Thank you very much.
Sharing your thoughts about what European investors see about the United States.